All right, good morning, Alta Realty Group agents. This is Kevin Lauren. I'm the Director of Training and Marketing here. And today we're going to be going over the California housing market. We're going to look at what's going on in different areas and look at the stats. Always helps to occasionally analyze the numbers. They speak volumes to us. So this will be a great interactive webinar. If you guys have audio on your computer or on your phones and you have some kind of an input for today's webinar, just go ahead and put it in the chat, and it'd be great to hear from several of you guys today. So before we get into our presentation, also want to welcome a few of our new agents. It's great to have our new agents on the line with us, joining us every Wednesday. And another great announcement is we officially have Don Kearney joining us, and he has taken up the position of the Greater Inland Empire Manager. So welcome, Don. It's great to have you aboard. It's really a huge asset to the team, and we really appreciate having you on board. And another housekeeping item is we have officially switched over to dotloop as our transaction management system. So if you haven't opened up your dotloop account and checked it out, please do so. Again, everyone on the call and everybody that's an agent with us should have received a welcome email from dotloop. Occasionally that goes into spam. It did go out about 2-3 weeks ago, so you may have to do a search in your inbox for a welcome letter from dotloop. So please look for that. If you have trouble, don't hesitate to contact me, and we'll have to get you in touch with dotloop support. But they have a really good support system, so shouldn't be a big issue to get everybody transitioned over. So I know a lot of you guys have transactions still open in SkySlope. It's okay that you guys close those transactions in SkySlope, but anything new, any transactions that are open basically from September 1st forward, we do need those in dotloop. So without further ado, let me bring Bill Seitz from Clearview Mortgage on the line. Good morning, Bill. How are you doing today?
Good morning, Kevin. I'm doing well, thank you. Do you hear me?
Okay, now I can hear you. Sorry about that, Bill.
No worries. Good morning, Kevin.
Good morning.
First off, I got a comment on the beard. So the beard is unbelievable. That is so we had our technical difficulties last week. I'm sure we would have saw progress of the beard in its growth pattern here, but
true. Apologize for that.
I've known Kevin a long time, everybody. I've known him since I was about 8 or 9 years old. So this is the first time I've seen him grow a beard. So we're in unprecedented territory here.
It's the first time I've grown a beard, Billy boy. So yeah, here we are.
Yeah, that's good. It looks good. Looks good.
I was going to shave it, but if the wife likes it, what are you going to do? Right?
Hey, beards are in. Beards are cool these days.
I have no saying it at this point. Okay. Just following orders.
That's so funny.
Good stuff.
Anywho, yeah. Well,
yeah.
Happy post Labor Day, everybody. Hope everyone had a good long weekend. I know we didn't get a chance to have our meeting last week, which sometimes happens, but here we are.
Yep. Oopsie.
And I think Cameron's gonna pop on too, Kev. I think he's gonna kind of give us our kind of mortgage market update, and then let's jump into the 3 points.
Yeah, for sure. So Cameron, good morning. How are you today, pal?
Good morning. Good morning. How's everyone doing?
Doing well.
Good. So yeah, short and sweet. So welcome all the new realtors that are on the line. Of course, it's great to have everyone on the team. I know we've had a lot of additions. We didn't have a meeting last week, so this might be the first time that you're hearing from me, but I'm a loan officer over at Clearview, and I like to hop on the webinar and give you guys a quick mortgage update so you know what's going on in our realm of the business. So I'll get started. So right now, the 10-year treasury is sitting at 1.35, so up a little bit from last week, but the interesting thing is we had a jobs report come out on Friday with 235,000 added for the month, but the estimate was more around 720,000. So if that poor jobs report, we can almost guarantee that these rates are going to come back down. The last 4 or 5 months, it's been kind of choppy up and down. And, it's really just all about timing right now. But I think in the long trend of things, rates are going to continue to trend down. At least that's my guess. But with these economic numbers, looks like that's pretty much what's going to happen. And then on another note, I've been getting a lot of calls from realtors lately as far as like down payment assistance programs and like that to help first-time home buyers get into homes. Something else that I want to touch on that maybe some people don't know about is that if you have a first-time home buyer, we can go 3% down on a conventional loan. So that is obviously 2% less than the 5% requirement that you would have if you're not a first-time home buyer. But something to keep in mind, because basically that's less down than an FHA loan, but you're still getting a conventional loan, which means that you're going to have lower mortgage insurance, and your offer is a little more attractive too because it's a conventional loan. So that's going to help people qualify, because sometimes that mortgage insurance for the FHA loans will, if it's a tight loan, might kill the loan because the payment's too high. So something to keep in mind. And then you can use gift funds for that as well. So sometimes that 3% conventional is better than a down payment assistance anyway, because you're going to get a lot better loan. It's going to help you qualify. And then, if they have family or something that wants to give those funds, that's very easy. A gift letter and take care of that in escrow. So piece of cake. And then something else I want to touch on for all the new realtors we have on the line. We pretty much here at Clearview Mortgage, we are kind of like your one-stop shop as far as availability of loan programs. We can do everything from jumbos to manufactured homes, FHA, VA. We can do bank statement loans, cash flow loans, obviously conventional. And we can also do home equity lines, which is great if maybe, you have a client that owns a couple other properties and doesn't have enough funds for a down payment. We can get a quick equity line to get that, to make maybe their offer more competitive or you out as far as getting your offer accepted. So lots of different options. And then as far as efficiencies and everything and turn times, it's extremely efficient and quick compared to like most retail lenders or banks. We're averaging, I'd say, probably around 2 weeks if you need an appraisal. And then, down from there if we get a waiver. So lots of tools at your disposal here at Clearview, and all the new people, we really look forward to working with you. We've obviously had a lot of success recently working with realtors, and we hope to just keep growing on that. So, but I hope everyone has a great Wednesday. And if you have anything, Bill, you can add to that.
No, thank you, Cameron. No, you hit a lot of good points. I want to just have Kevin queue up before we kind of get into a market update, the 3 points with Matt Ishbia, because it's really relevant to what's going on in the industry, not just in the mortgage, but just in real estate in general. And I think it's important for all of us to stay abreast of what leaders in the industry are doing and how they see the market changing and what's happening. So I don't know, Kev, you can pull that up right now. Let's jump into this.
Yeah, sounds great. And so if you haven't had your morning cup of coffee, Matt will act as your morning cup of coffee and will fire you up. So let's get involved.
Hi there, I'm Matt Ishbia, President and CEO of UWM, and this is 3 points. First point, Fannie Mae averaging median FICO score. So starting September 18th, Fannie Mae is going to change the way they review credit. And if you have two borrowers, one with a 700 FICO and one with a 600 FICO, in that situation, you can actually average the two together and call it a 650, not the lower of the two, and run it through DU that way. Now, mortgage insurance, a lot of other things are still going to apply to the 600 FICO, so it's not this big of an announcement, but it does give a little flexibility for some borrowers that were not able to be run through DU. So it's not changing the way loans are being done. You're not averaging a 750 FICO and a 700 FICO and calling it a 725. That's not what's happening. It's only in those unique situations where a borrower is below 620 where you can actually use the average to come up with a score so you can run it through DUs. Second point, appraisals. So we all know appraisals are the biggest Achilles heel in our industry right now. They're expensive for consumers. There's not enough appraisers out there. Things are taking too long. The quality is good, but not great. And as values go up, you're looking back 6 months on it. So values are coming in short. There's so many issues. Beyond that, back in the 80s, appraisers were paid $350, $450 per appraisal. Now we're paying $550 to $600, but that's with another $100 to $200 going to appraisal management companies, which are taking a fee. And so the appraisers aren't getting more money. It's expensive to become an appraiser. It takes a long time. There aren't that many new appraisers coming in the industry right now. This is a nationwide problem. With the COVID guidelines from Fannie Mae and Freddie Mac, it was a little easier. There's a little bit more appraisal waivers. There's a little more flexibilities. Those have kind of gone by the wayside. So it's really a tough time. In this industry, we have to look for solutions to the appraisal problem, appraiser shortage. How do we make it better? And there's a lot of technology and new things coming to hopefully make it better very soon. I think this industry is working on issues to make this better, but we're not there yet. And it's the biggest issue causing consumers issues and at the same time causing originators problems across the industry right now. Look out for new things coming soon from Fannie Mae, Freddie Mac, Ginnie Mae, and a lot of lenders working on ways to make this problem better. Third point, the foreclosure moratorium. So as a foreclosure moratorium comes to an end and the forbearances are leveling off or winding down, the market is gonna evolve. And so what does this mean for you? We have obviously seen housing prices go up really fast, and an inventory shortage. Well, with more people foreclosing and forbearances coming to an end, more houses are gonna come and hit the market, which means bidding wars and too few houses on the market, it's gonna end. There's not gonna be as much of that. I won't say it's gonna end, it's gonna slow down significantly. So the fourth quarter and first quarter see a lot more inventory, which means first-time home buyers can buy houses. Home prices aren't gonna go up as fast. So there's things that are gonna change with COVID, winding down and things changing with the foreclosures and forbearances. So be on the lookout. Inventory is going to come strong. Housing values are going to slow down from the appreciation, although they're going to still appreciate, maybe not as fast. And it's going to be a good market for consumers to come in and buy houses in the fourth quarter and first quarter of 2022. Thanks for joining me. I'm Matt Ishbia, President and CEO of UWM, and that was 3 Points.
Awesome. I'm fired up now.
Yeah. Well, I think he touches on, when I watched this last week, I really wanted to share this with everybody because there's key points here, obviously. One, it's really nice to know that they're going to be able to take a look at some of these buyer profiles. Let's say you have a husband and wife, one of the spouses has really strong credit and one has weak credit. If they're willing to look at that as an average, and take more of a, kind of a blended risk with them, which allows them to, maybe the couple to get into property where they couldn't, right? They can get into a conventional loan, or they can get into finance where maybe they wouldn't be able to. So I think that's a really important point, especially if you have borrowers that are that feel like they can't get financing. Well, maybe they can't, right?
Well, for sure.
And then number two, obviously appraisals. We all know the problem with appraisals, and Matt mentions this in the marketplace. So as listing agents or buyer's agents, we all need to be aware of what's happening, what the issues are. And to have a little bit of patience in that process, maybe, you have a listing and you've got a transaction going on and, it's taking a little bit longer than normal. Maybe you have a little bit of understanding what's going on in the industry instead of just, kicking out the deal and putting a notice to perform and saying, we're over you guys. You know what I mean? So as long as everything else is standing true and they're doing what they're supposed to be doing in the timelines of the contract, well, maybe we give a little bit of leeway, a day or two or whatever it is, to get this thing done and knowing what's happening in the industry, right?
For sure.
And then obviously number three, I think he touches on a really good point about the foreclosures and things that are probably going to happen here in the near future with more inventory coming in the market, which hopefully will take some pressure off of the amount of buyers that are that are fighting for properties with limited inventory. I think we're going to see hopefully some more opportunities for buyers to get into homes.
For sure. That was the big takeaway for me is, that, the forbearances ending and foreclosures probably coming up. I mean, we just know it's happening. So that will bring some more inventory into the market, right? Very cool.
Absolutely. You'll be getting inventory. It'll just kind of take the pressure off of, a finite amount now. As we see, unfortunately, there's going to be some issues around people losing properties, but it will give some relief.
For sure. And then Raj had a quick question for Cameron. Maybe you could answer it. He said, Cameron, on the 3% conv, did you say no, am I?
No, there is MI. It's just not like the, FHA. Like if you go with an FHA loan, the mortgage insurance is going to be significantly more, right? So with the conventional loan, it's just going to be depending on their credit. Like if you've got a borrower who's like 720, 740 credit, the MI is not going to be much. Under that, it's still usually over $100, right? But it's just going to save them, probably around, possibly $100 a month in mortgage insurance rather than going FHA. And then also too, another thing to think about is FHA loans, you have to pay that upfront mortgage insurance premium. So for some people, I'm not sure if everybody knows what that is. So basically, just like a VA loan where they have that funding fee, an FHA loan has an upfront mortgage insurance premium. So basically, even if they're putting 3.5% down, they end up really only putting down, around 2% because they're financing that insurance premium. So that's why they give them a little bit of a lower rate. But with the MI and the upfront insurance premium, literally it's a worse rate than a conventional, even though on paper it shows lower. So hopefully that answers your question. But basically, no matter what, if you can get into a conventional loan, that's the way to go. It's just going to save them a lot of money. And that extra $100 a month that you save in mortgage insurance, that's a lot of money. If you have someone who's sitting at, maybe 50% DTI and it's a really tight deal, it's going to help people qualify. But you have to make sure both borrowers, if they have a co-borrower, they have to be first-time home buyers, both of them. So that's something important to think about too. Because if you have one person who's a first-time home buyer and maybe their mom is going to co-sign or something, they wouldn't be eligible if they already own a property.
Got it. I guess that makes sense. All right, perfect. Well, thank you for that. Appreciate that, Cameron. So,
yep, no problem.
Yeah, so now let's get into the stats of the California housing market. And you guys can, I think it's a really good idea to as much as you can be, researching these stats on a regular basis. Inman is a good source for stats. There's a lot of different things. Just Google, California housing stats and so forth, and we can, take a look at this kind of stuff. So the first thing that I want to talk about is the statewide median price of basically how much annual income on average someone needs for a single family home in the second quarter of 2021 is $150,000 a year. So that is, that's giant. That's not that many people that make over $150,000 a year. So that stood out to me. Also, an effective composite interest rate of 3.2% would mean that a monthly payment on a 30-year fixed rate loan would be $3,770, assuming a 20% down payment. So that's a very high number as well. Judging by the rents in a lot of these areas, that still means that people could probably save some money. But that's just a whopping average, payment amount. So I thought that was a big stat to take a look at. And then also in July of 2021, all housing price gains were widespread within all 51 counties in the state, seeing annual price gains. So all regions recorded a double-digit surge in median price, with the far north being 25% and up the most year over year. So nearly all counties, 49 out of 51 counties tracked by C.A.R, recorded price growth on a year-over-year basis. So 46 of them reported double-digit increases from last year. So let's take a look at those double-digit areas. Not surprising, San Francisco Bay Area had a year-over-year gain of 23.9%, median price being $1.3 million. Ridiculous, right? Southern California had a year-over-year price gain of 21%. With the median price being $760,000. That's already, that's just ridiculous in my view. Central Valley, year-over-year gain of 19.7%, with the median price being $451,000. And then the far north, being Humboldt County and North Mendocino County, all those places far north of San Francisco Bay Area, they had a 25.7% gain. Median house price being $400,000. So an unbelievable increases in these home prices. Central Coast, that's where I live, 10% gain. That makes sense in my view, because there's not that much industry here. There's not that much that far to go. Median house is 869,500, crazy. Los Angeles metro area, 23.9% gain, and median being 731,000. And then the Inland Empire, where Don Kearney reigns supreme, 26%, with the median price being 529,000. So really intense price gains. So when we see gains like that, what does it tell you? You know, how long is that sustainable? It's not that sustainable, right? So we can probably, as we're already seeing, we can probably expect to see, you know, a softening. And as, you know, Matt Ishbia brought up with the, you know, the foreclosures coming up, forbearance ending, we're going to see a little bit more inventory. So that will help with this whole pressure of the supply and demand push, right? So, oh, good. John Espinosa has sound. Yay. All right, John, we'll bring you on in a second and see if you have a microphone. All right. So although the housing market appears to be cooling, it remains competitive. That's something that we know for sure. Homes spend an average of 17 days on the market. That's pretty quick still. Existing home sales increased at a faster rate than the previous month. Okay. NAR reports that sales increased 2% from the previous month to a seasonally adjusted annual rate of 5.99 million, up from a revised 1.6% increase in June. So still increasing the sales. Actually, that's volume, right? So housing sales were up 1.5% on year on year. Nationwide, sales for homes between 100 grand and 250,000 were down 28%. And again, we know that that's an inventory problem. Sales of homes between 500,000 and 750,000 were up 32%, because that's where all of the bulk of the sales are, right? And then sales of homes between 750,000 and 1 million were up 53%, which is insanity. But, you know, that's exactly what we've been seeing. So it's no surprise. So the housing market went through a huge shift during the COVID lockdown. Once the economy reopened, now sectors appear to be settling down. That's what Lawrence Yoon from NAR says. He's the chief economist there, of course. Before the pandemic, home sales were about 5.5 million, and now sales are under 6 million units. So definitely a little bit of a change there. The median existing home price for all housing types in July was $359,000, and that was up 17% from July. So just a gigantic shift, you know, and it can't last. So that's the one thing that we're really seeing in all these numbers. Each region of the US saw prices climb in July, every single one. That's also very telltale sign, right? This marks the 113th straight months of year-over-year gains, but marks a slowdown from from 20% to 29% price growth from a year ago. And then the median price growth was lifted by more sales of homes above $500,000. This rise in sales has been attributed to an increase in the housing supply. So we're starting to see that slow increase in the housing supply. And then as the late summer approaches, the months ahead contain critical clues to the post-pandemic future of the housing market. And so that goes again into what Matt Ishbia was talking about. So we're going to see a lot change over the next several months. Before I go on, Bill, you have any other insights at this point?
Yeah, you know, and this is all really driven around cheap money, right? If we didn't have cheap financing, there would be no record appreciation. We would have people not being able to qualify. People wouldn't be able to afford these new records. I think, I don't know if I mentioned a few statistics there, but I think the median home price for California now is $758 and change. So, you know, with property taxes and all the other bells and whistles, you got to have insurance to, you know, afford the financing of these properties. You know, a weak economy, which in Cameron even indicated the jobs report was a lot lower than what was anticipated or what was forecast. I think, you know, and then Matt kind of laid that over that with, you know, we don't anticipate double-digit appreciation, but we still anticipate appreciation. So, for me and just the way I feel and just being in this business for 20 years or so, is a healthy market is one that has a nice balance of buyers and sellers. It has steady appreciation, but not, off the charts appreciation. And, and unfortunately, there's no perfect, we've seen, peaks and valleys and, disaster economies and, and record, appreciation, whatever, over the last 20, 30 years. And it's just kind of the cycle for California. Unfortunately, that's the reality that we live in, living in California, selling real estate in California. But, I think that the silver lining is it's not supposed to be, the rug's not supposed to be pulled out from underneath it. It's just going to take, it's going to cool down, more inventory, which I think is more opportunities for everybody to advise your clients, because there's probably a lot of people on the fence saying, oh, maybe they're asking, Rhonda Butler or, one of our agents and saying, hey, what should I do? And, what do you think is going to happen? And I think all the data is telling us it's going to stay strong. It's still going to have appreciation, but it's just not going to be, if you're expecting to, buy a house and sell it next year for, $300,000 more than you paid for it, that's probably not going to happen. And that's not realistic.
Yeah, that's for sure.
But, people are getting record equity. So they kind of get that false sense of, it's kind of like the .com bubble, right? Where everyone's like, oh, I'm going to invest in, in NASDAQ and I'm going to, making, there's millionaires overnight. Well, people it kind of has that feel right now where people they just list their house for whatever they want and they think they're going to get it. Well, I think that's going to be coming. Those people are going to be facing some reality soon.
That's for sure. And Harold Erickson and John and Jennifer Espinosa and I, we talk about a lot of times, your clients want you to predict the future, right? And that doesn't really work either. So
no, but what you can do if you're armed with the data and you're on, and that's why we cover a lot of the stuff on the webinar. It's not, just marketing or just compliance. We talk about the economics and the financial side of it, because this is how you become educated. This is how you tell your clients with confidence. Right. I've heard from the industry leaders. I've heard from the banking CEOs. I've heard from, the area manager. I've studied C.A.R and NAR's data. That's how you become a real estate expert. That's how you become knowledgeable in your field. That's why we have to look at this stuff.
For sure. And, Don Kearney studies this stuff all the time. He's always sending me great, articles and insights. And, sometimes I haven't seen them, sometimes I have, but it's just really, really good to constantly be studying this stuff, as you said, Bill. So you're a real asset to your clients. You can't predict the future, but you can give them some pretty good information, and you can share stats and info that can help them draw the right conclusions as well. So a couple more stats, guys. And again, if anybody has a microphone, I haven't seen anybody volunteer and want to give us a little quick synopsis of what's going on in their area. But
what about Don, Kev? Is Don, does he have ability to get on? I'd love to, because Don is very knowledgeable, and now that he's a big part of the organization, I'd love to hear if he can get on what's happening, at least in the Inland Empire, because that's a booming market. And, we have a lot of agents that sell out there.
Yeah. Don, are you able to, do you have a microphone on your computer? You may not. Yeah. So maybe next week we'll have Don come on and I'll show him how to hop on the Zoom call with our phones. And then that way he can talk. But yeah, so let me just go over a couple more stats. Let me pull up a new little screen share here. And this is kind of cool. I'm a visual learner, so I like to look at graphs and so forth. So these following graphs kind of stand out to me. So California median home price dipped from the all-time, but remains above 800,000. So it's finally starting to come down, but that's really interesting. The median home price above 800,000. I think it was 811, which is insane, right? Active listings trending upwards, still more to go. And so look, the little blue column is 2021. So we can see that it's just still ticking up a tiny bit. And then August, we'll see what it ended up in the September, of course. Sales growth continued to moderate in all price segments. This is really interesting. We saw that huge spike as people freaked out and were bidding wars and money was rushing in and all those things were happening. And now it's coming way back down. So another good thing to look at and notice what the trend is. List price has had its first negative growth in nearly 7 years. So look at this, it fell off the cliff right here. List price, sales price, and list price have dropped dramatically. Okay, that's really interesting to see. That means, and we saw a lot of list price being low, and then of course the bidding wars were going on top of that, right? So very interesting to look at that. Inventory ticked up from prior month, but remains below last year's level. This is really interesting. So last year we were around September, we were around here. It's actually low. It's below last year's level. So inventory has gone down, but as Matt Ishbia has said, we may start to see that inventory level creep back up. So very important stuff for us to check. And then the last thing I want to look at is this mortgage payments are up double digits from 2020. That obviously has to do a lot with those prices rising, right, Bill?
100%. And I think too that the one variable we haven't mentioned is COVID. So obviously it's affected every single one of us. Nobody is immune from this, this crazy world we've been living in. And when we typically have a spring buying market, a spring, buyers come out for wintertime, they're thinking about schools and changing for kids for the future. Maybe they've outgrown their house. You have move up buyers. Maybe sellers are, thinking about, changing whatever. We didn't get that opportunity last year because there was so much uncertainty. There's new protocols for showing homes. Sellers are scared. Some people aren't comfortable with having people in their homes. So we had all this built up, pent up demand. And that I think is what we saw here this last, 9 to 12 months is once the comfort level and the protocols were embraced, we're like backlogged with people deciding to move or change their, situation. And I think now we've kind of moved through that big bubble of that pent up demand, and we should see a healthier environment.
For sure. So that is really good to see. Absolutely. So COVID, of course, really put a spin on what would have been, maybe a fairly normal market, right? So really interesting to notice all these things, to study these figures. So anyway, without further ado, I want to just thank everybody again for showing up on the Wednesday webinar. Again, please open up your Dot-Loop account if you haven't done so. If you have questions, don't hesitate to contact us. We're always here. And get out there, make it a great week, a productive week, and we will see you guys next week on the webinar. Have a great week, guys. Bye-bye.